We simply have got to talk about it today, and that is the rise of Bitcoin over the last couple of days. What's going on? Why is it rallying? Are there any specific data points that we can see that are going to lead to a conclusion that it's going to keep going? We're going to find out. And then the trading takeout is actually linked to Bitcoin, and it's how can we better risk manage certain positions and understand where objective places to get in and out of the market are. Make sure you like this video and subscribe to ensure I pop up in your YouTube feed every day, giving you the best market commentary and tips so that you can improve your trading edge. So it's happened. Mania is kicked off again in crypto, and Bitcoin has broken 60K, and it's trying to tickle the all-time highs again that we got in 2021 during the absolutely insane period that was there. Why is this? Why is this happening? Well, I think there's a couple of things going on at the moment. I think there's been some form of normalization in terms of us being now at higher interest rates. We're actually at the long-term average of interest rates. And people are looking at the NVIDIA stuff and thinking, well, why wouldn't I get involved? You know, there's stuff popping off in the equity markets, in the traditional finance space, that is, you know, exhibiting a form of mania. You know, I don't think it's necessarily unjust, you know. But then if we go and consider Bitcoin is one of the highest beta assets that are out there. It means it moves way more than the underlying benchmark, which might be the S&P 500 or something like that. And so you would expect Bitcoin to have moved already, and you know it has. It's trended really, really hard since basically 2023, the start of 2023. And I, you know, personally, I don't think it's done. I really, really don't think it's done. I think, you know, you should see some cooling off. You know, if we go to the chart here. There's periods like here where, you know, the market cools off for, you know, a couple of weeks, maybe even a few months, and it starts to chop. But you can't just expect the market just to keep going like that. It just doesn't work like that. You need to sort of recharge, if you like, put some new batteries in it and let some chop go on for a little while. But you can see how far away from these moving averages we are. And this is probably part of the reasons to why I think we need to have some form of volatility contraction here. I still think we could just go above here, but then I think what would have to happen is we settle around this range, around 60K, 56K. And I think from the perspective of the macro side of things, is macro really mattering at the moment? You know, we're at peak rates. I don't think we're going to go higher unless we get a severe inflation shock. Of course, this could be front running any kind of severe inflation shock. I'm not too sure, but I think it's really more a factor of, okay, well, people are thinking that rates are going to start coming back down again. There's the AI narrative as well. NVIDIA chips are used in Bitcoin mining as well. GPUs are used in Bitcoin miners, so the graphics cards. You know, if you remember a couple of years ago, there were a massive amount of graphics cards being bought to maintain these Bitcoin farms. And I think it's all kind of part and parcel of the general buying. And there was something quite interesting, if I can very quickly get it up, from JP Morgan. And it was from, I think this was the one actually. Let's have a look here. So it says down here, let's share this tab. My apologies, here we go. So this is the key chart here. This one where it says retail, institutional, etc., etc. So the importance here is that we are looking at institutional flows actually ticking up while retail flows are not. And they define institutional flows and they adjust it basically, adjust it for inflows into the new spot Bitcoin ETFs. The adjustment is needed because retail investors' Bitcoin holdings that have shifted to the new spot Bitcoin ETFs are technically held in larger institutional wallets, even if the end investor is retail. So they've had to basically adjust it for the specific movement. And so we are seeing more participation from larger investors. Retailers obviously ticked up as well, but it's good to see. You can see it all through here that this is the shift. And so I think in terms of that, we are seeing actual intent behind this buying. Obviously, seeing much higher marginal buyers, and so I think this is going to continue for a little while longer. There is obviously the issue with cascades, stop cascades, where longs can get taken out quite quickly, especially if they're on high leverage. But I think generally the trend is up, and our goal as traders, investors, is to look for opportunities where the chart is going up and to the right. In front of you is a tweet that I had put out, and I was basically explaining to my audience how to better risk manage your positions. And what you really want to be looking for is objective measures in the market that are based off of volatility, really. So in this example, what you do is you find the implied volatility of Bitcoin over a 30-day period, okay? And then you find the expected move from there by dividing the implied volatility by the square root of 365. Bitcoin trades 365 days per year, so that's what we're looking at. So what you can basically do as a crude measure is if you find the IV, the implied volatility, you divide it by 19.1, okay? And then that basically finds, the daily expected move. Then what you can do is if you then go to a chart, you can say, okay, well, if we go and find the Bitcoin IV now, okay, so we can look at it from, if we go to the block.co, they would have it here, and we find the 30-day one, and we see that it's at 57.12. So then we go 57.12 divided by 19.1. And the IV is 3, and the expected move is 3%. Okay. Obviously, what we're looking at the moment is a market that is exhibiting mania. So what can you do? Well, that initial daily move is only one standard deviation. Bitcoin trends when when Bitcoin is trending, it moves like 3 standard deviations sometimes. So what can you do? Well, you double it to find 2 standard deviations. So if we're looking at 3%, we're looking at 6%. And you can double it again to find 3 standard deviations. So this is basically how we start to factor in where the market could go. So this hasn't closed yet. That's the week. Sorry, let me go to the daily. So what we can look at is 3% to the downside. Let's just call it 2.9%. And then we can look at 3% to the upside. We'll call that. So these are the 2 prices that we're looking at for one standard deviation. Okay, and then if we draw a little line across here, we can see exactly what prices they are at. Okay, so what you can think of in this context is if you think that the market needs to, the volatility needs to come down a little bit, you can look at one standard deviation if it trades to the upside as a place to sell and mean revert. Or if it goes to the downside, you can look at it as a place to buy and mean revert. But then obviously what you might then be looking at is, okay, well, what if we think it's going to go 2 standard deviations? So we go down to 6%. And then we go up here on the upside, okay? And then you do the same. So that's for 2 standard deviations. So you have these objective levels that you can mark out that are based on actual volatility rather than eyeballing the chart. You can only do this for anything that has, options traded on it, because that's how it's calculated, which is most assets, to be fair. You can find the IV on CME website or wherever else they might be traded. So have a look at that, see if you can factor it in. Remember, the daily expected move is the 30-day IV divided by the square root of 365, which is 19.1 generally.